Let me tell you something that most people get completely wrong about China's latest move in the global currency system. They see headlines about digital yuan expansion, about oil contracts settled in renminbi, about central bank gold purchases, and they think this is just another round of economic competition. Just China trying to chip away at American financial dominance the way it's been doing for years. And on the surface, that logic makes total sense. Why wouldn't a rising power try to build alternatives to a system that gives its rival such extraordinary advantages? But here's where it gets interesting. And honestly, this idea flipped my entire understanding of how currency power actually works. What China just activated is not a weapon designed to destroy the dollar through direct confrontation. It's something far more sophisticated than that. It's a trap built into the architecture of the dollar system itself, and the United States has been walking deeper into it for decades without realizing the ground was shifting beneath its feet. You know what's fascinating to me? Everyone's asking the same question right now. If China genuinely wants to challenge dollar dominance, why hasn't it just dumped its massive treasury holdings and crashed the system? Why the slow, patient approach? Why build parallel payment rails and settlement systems when shock therapy would deliver immediate impact? And look, I get why people ask that. On the surface, it seems almost obvious. China holds over $800 billion in U.S. Treasury securities. That's leverage. That's a weapon sitting in the arsenal. But the moment you actually start pulling on that thread, you realize the answer is not what most people expect. Because what China understands, what it has understood for at least 15 years, is that the dollar system contains a structural contradiction that makes it simultaneously unbeatable in the short term and unsustainable in the long term. And that contradiction is not something China needs to attack. It just needs to wait for it to activate itself. To understand why that matters so much, you have to think about what the dollar system actually represents. Not as currency, not as money in the traditional sense, but as a mechanism of global power projection. The framework we need here is what military strategists would call systems dependency analysis. This is the lens through which you identify not the strongest components of a system, but the components whose failure would cause cascading collapse across the entire structure. In biological terms, you are looking for the keystone species. In engineering terms, the single point of failure. In strategic terms, the dependency that cannot be replaced once it breaks. The dollar system operates on a very specific structural foundation that most people never examine closely enough. At its core sits something called the petrodollar mechanism, established in the 1970s after the collapse of the Bretton Woods gold standard. Here's how the architecture actually works. Global oil trade, which represents the largest commodity market on Earth by volume and value, conducts transactions predominantly in US dollars. Saudi Arabia sells oil to Japan, the transaction happens in dollars. Nigeria sells oil to India, dollars again. This creates structural demand for American currency completely independent of America's underlying economic fundamentals. Countries need dollars not because they want them, not because the US economy is performing well, but because they need them to buy energy. That's the foundation. Now layer on top of that the question of where those dollars come from. The United States issues them. The Federal Reserve creates dollars through a combination of physical printing and electronic ledger expansion. And those dollars flow into the global system primarily through American deficit spending. The US government spends more than it collects in taxes year after year, decade after decade. That deficit gets financed through Treasury bond sales. Foreign governments and institutions buy those bonds, which gives the U.S. the dollars it needs to continue deficit spending, which pushes more dollars into circulation, which other countries need to buy oil, which creates demand for more Treasury bonds. The cycle reinforces itself. Each component depends on the others. Deficit spending enables global dollar supply. Global dollar demand enables deficit spending, and the whole system remains stable as long as that loop continues operating. But here is where the trap emerges, and this is critical. The system's stability depends on ever-increasing dollar circulation. As the global economy grows, as energy demand increases, as more countries need more oil, they need more dollars. The United States has to run larger and larger deficits to supply those dollars. The deficit grows not because of poor fiscal discipline, though that certainly exists, but because the structural role of the dollar in the global system requires it. The United States must be the supplier of last resort for global liquidity. That is not a policy choice. It is a systemic imperative built into the architecture. Now think about what happens when the national debt reaches $34 trillion. That is not a random number pulled from future projections. That is where the United States stands right now, today. Servicing that debt costs over $1 trillion annually in interest payments alone. $1 trillion every single year just to maintain the existing debt, not to pay it down, not to reduce the principal, just to keep the creditors satisfied enough to roll over the bonds when they mature. And here is the truly unsettling part for anyone looking at this system from a structural perspective. Those interest costs are growing faster than the economy. The debt grows faster than GDP. At some point, the math stops working. At some point, the question becomes not whether the United States can afford to service the debt, but whether the rest of the world remains willing to finance it. This is where China's weapon activates, not through Chinese action, but through American structural contradiction. Stay with me here because this is where it clicks. China does not need to attack the dollar. China needs to provide an alternative exit route for countries that are watching the debt trajectory and starting to ask themselves very uncomfortable questions about long-term dollar stability. Think of it like a building with one exit. As long as everyone believes the building is safe, nobody cares that there is only one door. But the moment smoke appears, the moment people start questioning whether the structure is sound, that single exit becomes a catastrophic bottleneck. Panic does not require fire. Panic requires the belief that fire might be coming and that escape routes are limited. What China has been building for the past 15 years is the second exit. Not a better exit, not necessarily even a safer exit, but an alternative. The Belt and Road Initiative was not primarily about infrastructure development. It was about creating trade relationships that could operate outside dollar dependency. When China finances a port in Pakistan or a railway in Kenya, the debt is denominated in yuan. The construction contracts are denominated in yuan. The future trade that will flow through that infrastructure can be settled in yuan. Each project creates a small pocket of economic activity where dollar intermediation is unnecessary. The digital yuan takes this several steps further. Most people think of central bank digital currencies as just electronic versions of existing money, and at the surface level, that is accurate. But the strategic implication goes deeper. Digital yuan allows cross-border transactions with near-instant settlement, minimal transaction costs, and complete bypassing of the SWIFT system that currently processes international dollar payments. A Chinese company can pay a Brazilian supplier in digital yuan. The transaction settles in seconds. No American banks involved. No dollar conversion fees. No exposure to U.S. sanctions that operate through the dollar payment system. The technology is not the weapon. The optionality is the weapon. Now let's go through exactly how this trap functions in practice, because the architecture is actually 3 separate games running simultaneously. Game 1 is energy settlement. For decades, if you wanted to buy oil, you needed dollars first. You sold your own currency, bought dollars, then purchased oil. China has been methodically building bilateral arrangements where that intermediary step disappears. Saudi Arabia now accepts yuan for oil sales to China. Russia accepts yuan. Iran accepts yuan. The United Arab Emirates accepts yuan. These are not symbolic gestures. These are the world's major oil producers, creating settlement mechanisms that bypass dollar intermediation for the world's largest oil consumer. Every barrel of oil that China buys with yuan instead of dollars is one less unit of structural dollar demand. Multiply that by millions of barrels daily. Extend it across years, and you are talking about removing one of the foundational pillars of the petrodollar system, not destroying it overnight, but eroding it gradually, predictably, and irreversibly. The Saudi decision to accept yuan payments was particularly significant, not because of the volume, but because of the precedent. Saudi Arabia was the original architect of the petrodollar system in 1974. Its willingness to accept non-dollar settlement signals that even the system's foundational participants are building optionality. Game 2 is reserve diversification. Central banks around the world hold foreign currency reserves as insurance against economic shocks. For decades, 60 to 70% of those reserves were dollars, because dollars were the only currency with sufficient liquidity and stability to serve that function at scale. That percentage is dropping. Not collapsing, but dropping steadily. European central bank data shows dollar reserves declining from 71% of global reserves in 1999 to 59% in 2022. That is a 12-point decline over 2 decades. Slow erosion, not sudden collapse. Where are those reserves going? Gold, primarily. Central banks have been accumulating gold at rates not seen since the 1960s. China's central bank has been buying gold every single month for over a year. Russia has been buying. India has been buying. Turkey has been buying. Poland has been buying. Singapore has been buying. These are not coordinated purchases. These are independent decisions by different countries, all reaching the same conclusion about long-term dollar sustainability. Gold does not pay interest. Gold does not generate investment returns. Gold just sits in vaults, inert and expensive to store. The fact that central banks are choosing gold over dollar-denominated assets tells you something about their confidence in the long-term purchasing power of those dollar assets. And some of those reserves are moving into yuan-denominated bonds. The volumes are still small relative to treasury holdings, but the trajectory is clear. China has been making it progressively easier for foreign central banks to hold yuan reserves by expanding bond markets, improving liquidity, and guaranteeing convertibility. The yuan is not replacing the dollar as the primary reserve currency. It is becoming the secondary option, the diversification hedge, the alternative that did not exist 15 years ago. Game 3 is trade settlement infrastructure. This is the least visible but potentially most consequential dimension. China has been building or joining payment systems that operate independently of Western financial infrastructure. The Cross-Border Interbank Payment System, CIPS, launched in 2015, now processes trillions of dollars worth of yuan transactions annually. It is not as large as SWIFT, not even close, but it exists. It functions. It provides the technical infrastructure for yuan-based trade settlement at scale. China has also been aggressively expanding currency swap agreements with other central banks. A swap agreement means two countries can exchange currencies directly without going through dollar intermediation. China now has swap agreements with dozens of countries, totaling over 3.5 trillion yuan in potential liquidity support. If a country faces a dollar shortage, it can access yuan liquidity through the swap line, use those yuan to settle trade with China or other swap partners, and avoid the economic disruption that dollar shortages typically cause. Think about what these three games create when they operate simultaneously. A Chinese company imports iron ore from Brazil. That transaction can settle in yuan through CIPS, bypassing SWIFT. The Brazilian central bank holds yuan reserves obtained through a currency swap with China. Brazil uses those yuan to buy Chinese machinery. China uses yuan to buy Brazilian agricultural products. The entire trade loop operates without dollar conversion at any point. Both countries reduce their dollar reserve requirements because they need fewer dollars to manage trade volatility. Now add to this something that makes the current moment particularly significant. The United States has been weaponizing the dollar through sanctions at an accelerating rate. Russia discovered in 2022 that centuries of dollar reserve accumulation could be frozen with a few keystrokes. $300 billion of Russian central bank reserves became inaccessible overnight, not through military action, not through legal proceedings, but through administrative decision by Western governments. That sent a signal to every other country watching. Your dollar reserves are not actually yours. They are permission-based assets that can be revoked if you displease Washington. The immediate impact was Russia's almost complete abandonment of dollar trade settlement. Russia now conducts the majority of its international trade in yuan, rupees, dirhams, and other non-dollar currencies. But the second-order effect is much larger. Every country that might potentially face U.S. sanctions in the future, which increasingly means any country that might take positions contrary to American foreign policy, has to ask itself whether dollar dependence represents an unacceptable vulnerability. That is not a small group. That is most of the global south, much of Asia, parts of the Middle East, and even some traditional U.S. partners who are watching the sanctions precedent and getting nervous. China does not need to convince these countries that the yuan is better than the dollar. China just needs to demonstrate that the yuan is available, that it works, that trade can continue even if dollar access disappears. The bar is optionality, not superiority. And the more the United States uses sanctions, the more it demonstrates to other countries why that optionality matters. Here's the historical parallel that makes this pattern recognizable. Go back to the British pound sterling in the early 20th century. For decades, the pound was the undisputed global reserve currency. Most international trade cleared through London. Most reserves were held in sterling. The system seemed unshakable right until it collapsed. What broke? It was not superior American economic performance, though that certainly helped. What broke it was World War II. Britain needed to run enormous deficits to finance the war effort. Those deficits required constant debt issuance. The debt eventually exceeded Britain's ability to credibly promise repayment. And critically, the United States had been building an alternative system through Bretton Woods that gave other countries an exit option when confidence in sterling began to crack. The transition was not immediate. Countries did not wake up one morning and decide to abandon the pound. They diversified. They slowly shifted reserves toward dollars. They began settling more trade in dollars. The pound remained important for years, but its dominance eroded until it reached a tipping point where the decline became self-reinforcing. Less sterling trade created less sterling demand, which weakened the pound further, which created incentives for even more trade to shift away from sterling. The feedback loop ran in reverse. The American dollar system right now faces a structurally similar trajectory. Massive deficits required to maintain global dollar supply. Debt accumulation that increasingly strains credibility. An alternative system being built that provides exit optionality. And critically, growing geopolitical tensions that incentivize countries to reduce dependence on a currency controlled by a potential adversary. You do not need perfect parallels for historical patterns to be instructive. You need structural similarities in the underlying dynamics. Project this forward, and what you see is not dollar collapse in any dramatic sense. What you see is erosion, a slow grinding reduction in dollar share of global trade settlement, a gradual decline in dollar reserve holdings from 60% to 50% to 40% over the next decade or two. Each percentage point decline means reduced demand for treasury bonds. Reduced demand means higher interest rates required to attract buyers. Higher interest rates mean larger debt service costs. Larger debt service costs mean bigger deficits. Bigger deficits mean more borrowing. The cycle that once reinforced dollar dominance begins reinforcing dollar decline. The tactical implication for the United States is increasingly constrained fiscal space. Right now, the U.S. can run trillion-dollar deficits because Treasury bonds remain the safe asset that global markets flee toward during crisis. That flight to safety dynamic depends on the perception that the dollar is the ultimate store of value, that there is no alternative with comparable safety and liquidity. The moment that perception cracks, the moment alternatives exist at sufficient scale, the entire fiscal model comes under pressure. The United States would face a choice between drastically reducing deficit spending, which means cuts to military budgets and social programs that are politically nearly impossible, or accepting higher inflation as the Fed finances government spending through money creation. The regional systemic implication centers on Asia. If yuan-based trade settlement becomes standard practice across Belt and Road countries, across the Shanghai Cooperation Organization members, across ASEAN economies, you create a zone of economic activity where dollar intermediation is optional rather than mandatory. That zone represents roughly half of global GDP and half of global population. Not all of that trade shifts to yuan, but enough shifts that the dollar's role becomes regional rather than universal. American financial sanctions lose effectiveness in that zone. Economic leverage that Washington has exercised for decades through dollar choke points diminishes. The global economic implication is fragmentation, not a clean split into dollar bloc versus yuan bloc, but rather a messy multipolar currency system where different regions use different settlement currencies depending on trade relationships. This creates transaction costs that did not exist in a dollar-dominant system. It creates currency risk that companies have to hedge. It creates opportunities for arbitrage and financial instability. The global economy ran more efficiently under dollar hegemony than it will run under multipolar currency competition. Efficiency losses show up as slower growth, higher inflation volatility, and increased financial crisis frequency. The structural order implication is the erosion of American unipolar moment. The period from 1990 to roughly 2015, where the United States operated as sole superpower, depended heavily on dollar dominance providing economic leverage that supplemented military power. Sanctions worked because they could cut countries off from the dollar system. Aid worked because it provided dollar liquidity. Alliance management worked because access to dollar markets and dollar-denominated investment was valuable enough to justify political alignment. As dollar centrality declines, each of those leverage mechanisms weakens. The United States remains a military superpower, but economic coercion becomes harder, alliance management becomes more expensive, and geopolitical rivals gain room to maneuver that they did not have when dollar dependence was universal. These trends are not happening in separate boxes. They interact. Economic multipolarity enables political multipolarity. Political multipolarity accelerates de-dollarization. De-dollarization forces American fiscal adjustment. Fiscal adjustment reduces military spending. Reduces Reduced military spending weakens alliance commitments. Weakened alliances create security vacuums. Security vacuums get filled by regional powers operating with greater autonomy. The cycle reinforces itself. So when you zoom all the way out and look at the complete picture, what you see is not China attacking the dollar through aggressive economic warfare. What you see is China activating a trap that was built into the dollar system from the beginning. The trap is the structural contradiction between needing to run perpetual deficits to supply global liquidity and the mathematical impossibility of running perpetual deficits without eventually destroying credibility. The United States has been walking deeper into that trap for 50 years. China just built the exit door that allows other countries to leave when the trap springs. The real question is not whether the dollar loses its dominance. The structural dynamics make that trajectory almost certain over the next 10 to 20 years. The question is whether the United States can manage the transition in a way that preserves enough influence to shape the post-dollar order, or whether the transition happens chaotically in a way that destroys American leverage completely. And right now, the evidence suggests Washington does not fully understand that the transition is already underway. You cannot fight a trap you do not recognize. And by the time recognition arrives, the trap has usually already closed. The next time you hear about China buying gold, about yuan oil settlements, about BRICS currency discussions, try holding all of these things together in the same frame, because they are not separate stories. They are different angles on the same story. The story of how a currency system's internal contradictions create the conditions for its own replacement, and how a patient rival builds the alternative infrastructure while waiting for those contradictions to activate themselves. Empires do not fall overnight. They erode. And right now, the conditions for that erosion are assembling with remarkable speed.